Thanks for being in today's webinar. This is Adrian speaking. I'm the head of trading here at TrendSignal, and today we're going to be taking you through the trading essentials and also how to build a trading plan. So this is very much for perhaps lesser experienced traders, shall we say, maybe those who want to take a step back and make sure that they are doing things in the right way. They understand some of the more sort of introductory concepts of trading. We're going to be going through all of that today and just make sure we're in the right position. We understand some of those fundamentals before we do get started with our own live trading, of course. So this is live, this is interactive. I'm talking right now, and there is a little risk notice I need to cover off on just before we do get started. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. The presentation has been prepared without the regard for your investment objectives or financial situation. All opinions, news, research, analyses, prices, and other information herein are intended as general information only and are provided on the understanding that TrendSignal is not rendering investment, legal, or tax advice. Good. We can breathe again now, can't we? And let's get started. Like I said, this is a live session. I am talking right now. You can get involved and ask questions. Can I ask you to do so now? And I know that we are streaming on the likes of YouTube, Facebook, and so on. So interacting in that manner is a little bit more tricky because I can't monitor all of those different places. However, if you are on GoToWebinar, you can get in touch here. So if you're on a smartphone or a tablet, there's a question mark at the bottom there. Hit that, allow you to type in. If you're on a downloaded computer, like a downloaded like laptop, desktop computer type of thing, then you may see GoToWebinar looking a little bit different like this. The small orange button. It may look different. It does depend on how you're accessing it, whether it's on the browser or the GoToWebinar program. Should be fairly simple anyway. Look for a speech bubble, look for a question mark, and then. But if you're on the laptop or desktop, it might look like the orange button here. Click that, allowing you to type in there. So if I get as many people typing something in, just type hi or hello into that questions box as possible, just so I know that you know how to get involved as we go through today's session. Okay. That'd be great. Okay, so what are we doing? There's two sections to this session today. And so the purpose is really to help new traders go through some of the basic concepts, make sure that broader understanding of how we go about trading, and then also to do with a trading plan. So how we put together a trading plan, what sort of things that we should be thinking about, strategy, entries, exits, rules, criteria, which markets, etc. We're going to be going through that later. But let's go through the essentials first, if that's okay. And as I said, if you've got any questions, keep them coming through, and I'll try and go through this from the ground up. So, markets to trade, pips and points. What does that all mean? Leverage, long and shorts, tax, different types of trading accounts, trading examples. We're going to be going through all of those. As I said earlier, for me, a lot of this stuff seems like information that experienced traders might take for granted. Well, of course, you know what leverage. Why would anyone know what leverage means and what it's all about? So we're going to be touching on all of those elements today. Okay. So the first thing we can look at is markets, and we can look at leverage as well at the same time. So when it comes to trading, there are a series of different types of markets or types of instruments that we might tend to trade. Forex is extremely popular, so that's a currency. I'm not going to go into what derives a price and all that sort of stuff. I think that's, prices go up and down. Let's just accept that fact. But what can we trade with a modern trading account? Now, this could be whether it's a CFD account or a spread betting account. You can trade margin FX as well, but that'd be limited to just foreign exchange. But typically on a CFD or a spread betting account, you'd have access to instruments such as Forex, foreign exchange, currencies, indices, stock indices. So that would be a market like the FTSE 100, the DAX, the Dow, the S&Ps, the Nikkei, the Hang Seng. So that is an index that's a measure of how the broader stock market is moving in each of those countries based on a certain number of instruments, a number of stocks. Commodities, gold, silver, oil, wheat, corn, frozen concentrated orange juice, all of this sort of crazy stuff. You can trade a number of those with different brokers, stocks and shares. It could be UK stocks, US stocks, and cryptocurrencies as well that some people can trade as well. Now, what you trade is really down to you to a certain extent. I would say that there are certain advantages, certain pros, certain cons with each of them. A lot of people historically probably have a broader understanding of stocks and shares before they get into trading, but that's not always the case, and certainly becoming increasingly less the case these days. I imagine, or I believe that when I first got into this in 2002, a lot of people back then were probably investors, traded a share portfolio already, probably had the benefit of privatization shares or demutualizations of building societies turning into banks. A lot of that created shareholdings for many people in a huge generation or several generations of people, certainly in the UK. They got people into trading stocks and shares as a portfolio, and then people as CFDs and spread bets became more popular. People then started moving into trading other markets or trading their stocks and shares in a slightly different way. The point is that we can trade all of these markets, and modern trading accounts can be extremely versatile to allow us to trade them. So currencies, forex, one currency against another. An index is basically a broad or an average or a stock market. It's like an algorithm of how stocks generally would move in combination. Commodities, of course, we might want to follow how gold's doing. It's a barometer for certain things. Oil, how that's doing. And other sort of commodities, which can be extremely interesting to trade. And commodities can move around a lot as well, and so on. Where it sits as a new trader, what might you want to do? Again, a lot of that is down to personal preference. New traders, I wouldn't necessarily say should look at one as opposed to another. Probably leaving cryptocurrencies aside. Those certainly are the most volatile of markets. But what you're really looking for as a beginner trader is probably to do with the amount of leverage that is available and the amount of leverage you use and the amount of minimum trade size that you can do. So what you're really looking for as a beginner doesn't really matter which type of market it is. You're looking at something that allows you to trade quite low risk and keep that to a minimum level until you have that confidence. But we can talk about that a little bit later on. What I do have in here is in brackets there, something to do with the leverage. Do we all understand leverage and margin and what that all means? You can just give us a quick yes or no in the questions box. Certainly, I think it's an important thing to go through. I know that a lot of people who I've spoken to in the past who start off by trading traditional shares with their stockbroker. The whole idea of CFDs and spread bets. Oh God, leverage trading, that's extremely risky, isn't it? It's risky if you treat it in a risky way. Leverage gives us a lot of flexibility, a lot of options. It doesn't have to be any higher risk if we treat it correctly. As an example, let's say you wanted to trade shares. How does that work? Well, if you were going to buy shares with your stockbroker, if you wanted to buy £1,000 worth of shares, and you had £1,000 on your account, that's fine. That's all that you could do. And if the market were to move up 10%, then you'd make £100. If it moved down 10%, you'd lose £100. Pretty straightforward, really. You trade that as a CFD or a spread bet, you get a leverage factor of 5 to 1. So what does that mean? It means with every £1,000 on your account, you have £5,000, times it by 5, you have £5,000 worth of buying power. So the notional value that you can buy on a CFD or spread betting account will be 5 times that of the money, the capital that you have on the account. So with your £1,000 on your account, you could actually buy £5,000 worth of shares. And you're right, on that basis, that seems extremely risky. But there's a number of things with this. Number one, just because you can doesn't mean that you should. There are other benefits of spread betting and CFDs which are way beyond leverage alone that still make it very attractive to trade in that way. What this also means is that you might have wanted to buy 5,000 anyway, but you only need £1,000 on your account to do so. That can leave you allocating more capital in your high income savings account or in your stocks and shares ISA. So actually you only have to put a smaller proportion of your capital into a trading account in order to trade with the money that you really want to. It allows you to use your capital more wisely. So there's an advantage certainly to do that. And just because you can buy 5,000 of a stock with your 1,000 doesn't mean A, that you would, and B, you don't have to put it all into one stock. So even if you wanted to use that leverage, what you could do is, instead of buying £5,000 worth of, say, Vodafone shares with your £1,000 on the account, what you might decide to do is buy £1,000 worth of Vodafone and £1,000 worth of BP, £1,000 worth of HSBC, £1,000 worth of Scottish and Southern Energy. I don't know. You can actually spread the risk and diversify that risk across a wider portfolio. So it just, what it does is it gives you flexibility, and flexibility that just simply isn't there with a traditional share dealing account. So, why do people believe that trading with leverage is risky? Well, let's go with it this way. If you're trading at 5 to 1, that's a 20% margin requirement. Okay, so 100% divided by 5 is 20%. Basically means that is the amount of money, or the percentage, that the stock price would need to fall before all your capital is gone. Now, margin constraints are a little bit different than that anyway, but the point basically is this. If you bought £5,000 worth of stock and you only had £1,000 in your account, then effectively, if that stock falls in value by 20%, that is your entire capital gone. Now, that's where it sounds kind of scary. How likely is that to happen? Well, it depends on really what's going on, doesn't it, and how good your stock selection is. But the point is, it can happen, and that's why people think it's a bit risky. But of course, it's only risky if you bought a £5,000 worth in the first place. The other thing with it is that it's no different really to buying a house. The only difference is that the likelihood or the speed in which the value of the instrument you're trading works. Now, a house price is going to move a lot more slowly than a commodity price or a stock price. But we are used to leverage in our day-to-day activities. So, for example, if you're going to buy a house and you're going to buy a house for £100,000 worth, that's the cost of it. What's your deposit? Well, your margin is going to probably be 10% requirement. The bank will probably require you to put £10,000 down, and then you get a mortgage for the rest. That will be a 10% deposit, which effectively is a margin rate of 10 to 1. So we're using leverage when we buy a house. So a lot of people, I'd never use leverage. Most people who own a house, unless they've fortunate enough to buy it in cash, they're using leverage every single day. But they just don't necessarily realize it that way. You still got the same risks associated with that. If that house price were to fall by 10%, the margin requirement, the deposit amount, if you like, all these same words basically mean the same, and it fell to £90,000 value, then your capital would be gone. Just like a 20% fall in value of 5,000 would be your deposit and margin requirement gone as well. These are no real difference. The difference is really down to the speed in which the instruments move, and then the attitude to risk that you might have. The reason why these levels are set where they are is really down to what's a kind of a normal bad day, bad move. How much is an instrument likely to move in a day when it's really bad? Okay. Because what the regulator wants to do is put traders in a position where they can't have their account go into a minus territory, right? And there are rules with FCA rules in the UK where that can't happen now if you're classified as a retail customer. But the point is, that the amount of money you need to put onto your account is really based on what a kind of a really bad day might look like. So, for example, 5 to 1 basically means that there's a 20% requirement on that account. So if £5,000 worth, you need £1,000 on your account. 5 to 1, that's 20%. So basically what that's saying is a really bad day on a stock will be a 20% fall. Okay. Now, normally a bad day on a stock is a 3 or 4% fall, but a really, really horrible day over a profits warning or something like that might be 20%. Now, that's not to say that it couldn't move more than that in a day, but it's basically looking at a common bad scenario, if you like, common really bad scenario. Equally, a commodity that trades at 20 to 1 typically with your broker, could be 10 to 1 depending on the broker you're trading or the instrument you're trading, but effectively what that's saying is a 5% fall is a pretty big fall in a day. Therefore, that's what they're setting that level at. Indices, again, 20 to 1, that's a 5%, so you need 5% down. So if you want to buy 100 grand's worth of index value, you need 5%, £5,000 on your account to do it. Because 5% would be a pretty disastrous day on an index. It's very unusual for it to move more than that. Equally, for a currency, 30 to 1, that's about 3.3% margin requirement. So why is that useful? Well, currencies, notwithstanding what happened with some of the yen pairs yesterday, very unusual for a currency to move more than about 1%, 1.5%, to be honest with you. So a 3.3% move is pretty large, really, that you would find there. So the margin rates are based on that, and why are a lot of cryptos 1 to 1 or 2 to 1 or something like that? It's because they fly around like Billy-O, really. Guys, is this all making sense so far? I know that for some of you this might be pretty straightforward. You're thinking, I know all this, Adrian. That's fine, but not everybody does. I just want to make sure we're all making sense so far. So that brings us to the different types of trading accounts that might be there. We wanted to talk about, margins. We've talked about that. We can talk about costs and so on. One of the things that's a real advantage, particularly this year, the stock market is down this year. And I think for a lot of people, you start to think, well, if the stock market's down, I don't have an ability to make money. Many more people are experienced or have an understanding of how shares work than they might do with currencies. But the thing with all of these markets is if you're trading as a CFD or a spread bet, you can make money on rising prices and you can make money on falling prices. So a falling stock market is extremely attractive to a trader, just like a rising market is extremely attractive to a trader. It presents effect if you compare the ability to trade as a CFD or a spread bet, and the fact that you can make money on falling prices, it effectively doubles the number of opportunities that we have against somebody who's just trading on a share dealing account. So share dealing, long only, it's fine. You've got to put all of your capital into an account. So if you want to buy £1,000 worth of stock, you need £1,000 on the account. You don't if you're trading as a CFD or a spread bet. You can only make money on rising prices, which is fine if the stock market is rising. We're in a bull market. We are not in a bull market right now. So that means that it's attractive to have a long and the ability to short the market. Tax-wise, what are the advantages there? Well, there is something called capital gains tax in the UK. Now, different countries have different tax rates and so on. But if you wanted to trade shares in the UK and you're trading on a traditional share dealing account, then the profits you make are liable to capital gains tax. Now, there is a minimum tax allowance that you're allowed to make before any tax is paid, but there is tax to be paid. If you've got a big portfolio, if you make lots of money on your share dealing account, that's a cost that you've got to bear. Not only that, but you can also pay stamp duty, which is typically in the UK 0.5%. Doesn't sound like a lot, but when you're trading and you're trading more actively, that 0.5% can become quite expensive. After all, you do £100,000 worth of volume in a month, that's 500 quid. You don't have to pay that. There's no stamp duty associated with trading UK stocks if you trade them as a CFD or if you trade them as a spread bet. Okay, and what's the difference between them? Do they move in a different way? No. You have leverage. You have the ability to go short. You don't pay any stamp duty on them, which means you're saving 0.5% every time you place a trade, which can be extremely attractive for your dealing costs. And also there's no PTM levy as well. I know it's only £1, but but if you trade over £10,000 worth of shares, you've got to pay a pound. It's not a lot, but you don't pay that with CFDs or spread bets either. You do still pay as a CFD, you still pay capital gains tax, but so be it. There are efficiencies to that anyway if you're hedging. But if you trade it as a spread bet under current legislation, there's no tax to pay, no income tax, no capital gains tax by trading as a spread bet, and you get all these other advantages with it as well, but without even the requirement to put it on your tax return. So that just makes it really attractive. You've got the leverage, you've got the long and shorts, you've got the lower tax costs that make it an extremely attractive way to trade. Predominantly UK only for spread betting, but for CFDs, it's largely global. There are some countries that don't allow CFD trading, but that's okay. And share dealing, you can pretty much do that anywhere in the world. All right. So from my perspective, I like CFD trading. I prefer spread bet trading because I actually find that it's just more straightforward. The packaging of it, there actually is a product, as a financial product, or the way in which to trade. The packaging it's only really slightly different. They're basically the same thing. And in fact, if you really want to know, if you want to trade shares as an example, and I go with the shares example because it brings in share dealing as a trading vehicle. If you were to buy say 100 shares of a particular market, notwithstanding costs, the profit or loss that you make on a trade will be exactly the same as trading 100 CFDs or trading £1 per point as a spread bet. Okay, so notwithstanding costs, the profit or loss, the gross profit or loss that you make, whether you trade as a share dealing account with 100 shares, 100 CFDs is exactly the same, or £1 per point will be exactly the same. Okay, that's against trading UK shares, by the way. All right, so really, if you're thinking, well, what size am I supposed to trade? Well, if you can work out the number of shares that you trade, then all you've got to do is scratch off 2 zeros or move the decimal point twice, and then you've worked out the pounds per point that you would trade. It's pretty simple, but you get all those other associated benefits really with that. Okay. So just quickly, can I get a yes or no from everybody? Are we okay with all of this so far? Let me know, please, in that questions box. I want to make sure we're all cool on that. Just give us a quick note if you don't mind. Okay. Let's think then with a couple of examples, and let's think about what we can look to do now. Let's have a look at foreign exchange, just so you can think about how a broker platform might work. Now, different brokers are going to show prices and things in a slightly different way, but there are certain things that we can see with it that can allow us to get an idea about how markets move in points or pips and what the notional value is. Now, this is particularly important when you're going to trade as a spread bet, because when you trade as a spread bet, you're trading per point movement. Okay, so if you trade £1 per point, that basically means you will make or lose £1 for every point or pip that market moves in your favor or against you. So if you buy a market at 100 at £10 per point and it moves in price to 110, that is moved up 10 points. Times by £10 per point, 10 times by 10, that's £100 profit on that trade. Okay, so what you need to know, particularly if you're trading as a spread bet, is what on earth is a point? Where is my point? What does a point constitute when I'm looking at the actual price? And actually, brokers can usually try and make this a little bit more straightforward these days. And you'll see that by here, as an example, I've got the pound against the US dollar as an example here. Now, I know these prices are way out of line from now. It's an old example or screenshot. It doesn't actually matter, though. Now, pound against the US dollar typically will trade to the fourth decimal place. So it'll be 1 point, in this case, 3969. Okay, so why is that useful to know? Because it means if we know that it moves to this fourth decimal place, it means that if it moves from here, from 1 to 2 to 3 to 4, that is a pip. So if we're trading £1 per point, for every time this decimal moves up or down, we are making or losing, right? So that's what we're staking to. That helps us to then work out what our notional trade size will be and so on. And then from then, that allows us to work out what our margin requirement would be as well. What I've got here is the price. Now, often what you'll see here is a bid price or the sell price, and then the ask price is the buy price. These are the prices which you can trade, the level 1 prices that we can trade. If we want to buy this market, we have to pay the right-hand price. If we want to sell this market, we have to sell at the left-hand price. And in here, you'll see the spread. The spread is the difference between the sell and the buy price. In this case, it's 0.9 pips, 0.9 points. Okay, and I've written that out there. So the difference between 78.3 and 79.2 is 0.9. So what is that spread? That is the difference between the buy and the sell price. That is effectively how far this market needs to move in your favor before you are break even on that trade. So that is your implied dealing cost. So if the market has a spread of 0.9 pips, basically, as soon as you place that trade, you will be down 0.9 pips. Just like a broker would charge you a commission and so on, this is effectively your cost. So if I did £1 per point, immediately, as soon as I place a trade, because I buy on the right hand side and I sell on the left hand side price, immediately I'll be down 90 pence. Okay, but if I make 100 points on the trade, then really there is no cost, if you like. It's not an amount of money that comes out of my account like a commission, but what it is, it just means the price is just going to move a little bit before I'm in a profit there. Okay, so the spread being 0.9 points is actually pretty narrow, to be honest with you. Particularly if you're looking for, say, 30, 40, 50 points or something like that for a trade, that's a very low dealing cost in reality. Um, okay, so and what you'll notice with brokers is, and you can see it down here, it's a little more subtle here, but you'll notice that the font size, the size of the numbers is a little bit bigger for the 7.9 and the 7.8. Now, why is that? Because that the broker is demonstrating you to the pip movement. So if the price moves from 78 to 79 to 80 to 81 and so on to those decimal places there, that's the point. So they'll always, or most brokers will bolden or make it bigger size, the numbers slightly bigger, so that you can see very clearly what you are staking it to. So if we move from 78, 79 to 80, 81, 82, that's how we're making our profit. Okay. What you'll often find with the broker is what you call like a fractional point after that. It's like a decimal of a pip or point, point one of a pip type thing. And that's just to provide us with more accurate pricing. Okay. So that gives us a basic idea, the price at which you sell at and then the price at which you buy at. Why is there a difference in those prices? There has to be, because the broker's got to make a bit of money with the commissions, but in any case, even in the raw market, the underlying market that this is a derivation of, there has to be a difference between the buy and sell prices, because in a marketplace, you are matched buyers and matched with sellers. And if a buyer wants to buy at the same price that a seller wants to sell, they're going to be matched. And they'll be instantly matched until there is a disparity between the price at which somebody wants to buy at and the price at which someone wants to sell at. Therefore, in a market, there has to be a disparity. Otherwise, the buyer will be buying off the guy that's selling at the price that they both want to trade at. So it's kind of a bit difficult to explain, really, I think, probably without demonstrating something, but we can do that another time. What that does, it gives us an idea about how market is pricing, what our raw dealing costs are, but then also in terms of our notional value. Remember, if you're going to work out what your margin requirement is, we need to work out our notional value. And the notional value sometimes can actually get people a little bit scared because it always sounds quite high. But remember, markets don't move all that fast, particularly currencies in percentage terms. They can do occasionally, but it's pretty unusual. So notional value is basically the value of the trade that you are doing. So if you wanted to buy £5,000 worth of Vodafone and you only had £1,000 on your account, you could do that. The notional value would be £5,000. Now, how do you work that out with a spread bet? You take the number of pips that are in the price, or the price in pip terms, and then you multiply it by the stake that you want to trade. So for example, if I wanted to buy pound against the US dollar, I would be buying it at this price, okay, or this price here. I would then multiply that. I'll then basically look at this in terms of its pips. So in this case, my decimal point, I'm going to move it to here, which basically means that my notional value is going to be 13979.2, that's the pips price, times it by £1 per point, that's the stake that I want to do, which gives me a notional value of this. So effectively, by trading £1 per point, it means that I'm buying £13,979 worth and 20 pence worth of pound against the US dollar. Okay. And similarly, if you're going to trade the FTSE, let's say FTSE is trading at 7,000.0. Effectively, if I do that a pound a point, well, it trades to the full point, if you like. So effectively, £1 a point would be £7,000 worth notional value. So you take the pips or the points, times it by the stake, and that'll give you a notional value. Now, in terms of your margin requirement, we can go back to that previous slide. Forex currencies within the European Union and the UK trade at 30 to 1. So you simply divide that notional value by 30, and that will give you the margin requirement. So if you wanted to trade a pound per point, how much money do you need on your account to do it? Well, at that price, at a 30 to 1 margin rate, then you need £465 for every £1 per point you want to stake. So if you wanted to do 10 pence per point, you need £46 on your account. If you wanted to do £100 a point, you'd have to have, 46,000 on your account, and so on. Okay, so it's just simple maths, really, but as long as we understand what the formula is, maths is easy if we know how to calculate it, doesn't it? Isn't it? And similarly, it depends on the different market that you're going to trade. So you would divide by 5 if you're going to trade a stock, for example. So it just depends on what it is you're actually trading. Now, I always like to show a yen pair because there was a bit of a difference between most currency pairs and when you're trading one with a JPY in it. And that's because there's an awful lot of yen to $1, to €1, to £1. So if you actually think about it, it's around about 1 currency against to one other currency. I mean, it's not, there might be 2 or might be 0.6 or something like that, but it's similar enough to 1. But actually, when it comes to yen, it's not. If you look at yen here, it's effectively $1 will buy you 107 yen. So, you're not going to trade that to the 4th decimal place. It doesn't need that level of pricing. It trades to the 2nd decimal place. So if it's trading at, in this case, 108.412 to 108.42, effectively it's 108.41. That's the bit that's in bold. To 42, that's the pip. So again, the spread is 0.8 points. That's the difference between these two prices. That's your implied dealing cost. Dollar yen is typically quite a low dealing cost market. And then effectively what you've got there is the bigger font here in the price to tell us what we're trading it to, 2nd decimal place. So effectively for dollar yen to move 100 points, it would go from 108 to 109.00, 0.41 or whatever it is. It will be a big move, if you like. Notional value, very similarly, you look at where the pip is and you just move the decimal point to the right of that. So effectively, that means that the decimal point for this would then be at 108.42.0. Put the decimal point to the right, times it by a pounder point, and it gives you your trade size. If you want to do a pounder point on that, you need £10,842 notional value. You need a 30th of that, or 3.3%, in order to trade that, which is approximately 362 quid. All right. Okay, so that's basically it. That's how we look at what the spread is, pricing, pips, and so on, and then what our stake of our margin requirement would be for every stake for what we want to do. Now, of course, like I said, in this case, if you want to risk 20 quid on a trade and your stop loss is 20 points away, then a pound a point's fine, isn't it? If your stop is wider and you want to risk that £20 on a trade, then you're going to have to do a smaller stake per point. And it's important that you trade with a broker that allows you to trade smaller size as well. So, in my experience, I find that, flexibility to trade from around 10 pence per point is pretty good, because it means that we don't have to take unnecessary risk, particularly on a market that's moving really fast, or a market that has quite a high price, or just because we might want to test out a strategy once in a while, or maybe we've got a small account size. All of these things are fine, and we should be able to trade with the flexibility that we want. Okay, so kind of basics really. These are important things really. What I want to do now is just move on a touch to trading plans. Now, I'm not going to go too long into this one, but this is one of the things that creates a real problem. So we might have the basics, but what you really need to know is what to do with those basics and make sure you've got a strategy. There are a significant number of traders that lose money from trading, and about 40% of traders quit after just 1 month of trading. That's a pretty sobering thought, and a lot of that is down to not having a strategy, or even the right strategy, or even thinking about it in the right way. What you need to have is a trading plan, and that sounds really boring, doesn't it? But pretty much everything else that we're going to do successfully, we're going to plan it in some form, whether that's a business plan. If you're going to be, there's a similar sort of, drop-off rate with small businesses. What is it, about 90% of startup businesses fail within 5 years or 3 years or something like that. Why is that so high? Well, think about how many businesses are set up by somebody who doesn't investigate, what their costs would be, doesn't, think about who their competitors are, what their pricing points are. Is there a demand for the products they have? How are they going to put it to market? What's that going to cost? What are their overheads going to be? What are their forecasts going to be? The more that these companies and individuals plan, they look at the threats, the opportunities, and so on, the more likely it is they're going to be successful. If you're going to be a pilot, you're going to do a pre-flight checklist just to make sure that everything is in the right way, in the right place, and so on. Trading should be exactly the same. The reason a lot of traders lose money is because, apart from anything else, they may not have planned it all out properly. That's not to say it's the route to absolute success, but it's certainly a part of it. And the more you can think about that, the more you can hold your discipline. Effectively, what this is, a business plan allows you to have a disciplined approach to your business. A pre-flight checklist, if you're a pilot, allows you to have a disciplined, rules-based approach to the way in which you're going to fly, so that you don't have unnecessary risk. Trading should be exactly the same. You know, people who lose money by and large often make those emotional decisions, make the decisions based on, whimsical type of trading rather than actually focusing on a rules-based approach or a proven approach that they may not actually even have at this point. But that doesn't mean they shouldn't have or even thought about it. So, as one of our members says here, if you can follow rules, take your time and listen to your coaches, you'll make money. If you don't listen, if you have no patience, and if you can't follow rules, go and do something else because trading isn't for you. And I think that's absolutely spot on. But of course, you can only follow rules if you've actually acknowledged rules in the first place. So if you don't have a rules-based approach to trading, if you don't have your pre-flight checklist, if you like, then it's going to make trading really difficult. And the reason for that is there's nothing to hold you back. You listen to some dude in the pub and he's talking about some amazing stock that's about to go, out of this world in value. Suddenly you're going all in. It's like, no, hang on a second. I need to think about whether I should even be doing something like that. And if I do, what trade size should I do? How should I do it? Where should I do it? You need to think about these things more consciously. After all, let's face it, any money you're putting into a trading account, I would expect you've worked really hard to get that money. Okay, you've paid tax on that money. And so what you don't want to be doing is throwing it away frivolously. You want to be making sure that you are consciously making decisions with that. So you don't throw it away quickly because it's taken a long time to earn it. Let's make sure you're using it with that respect. And it sounds obvious, doesn't it? But you wouldn't believe how many people are just very, very cavalier with the way in which they trade. And I guess generally in life anyway, isn't it? So what should be in a trading plan? Now, look, I'm not going to go through each and every one of these things. It's just something more for you to think about a little bit. But, first of all, what time frame should you trade? When are you able to look at the markets? That's important. Which markets are you going to trade? Because, which markets you're going to trade is important because suddenly you find yourself trading something else and it's like, well, why am I even trading this bloody thing in the first place? I shouldn't be anywhere near it. What on earth am I doing looking at Eurodollar when I'm supposed to be trading stocks? It's fine to look at these other markets, but you should probably do it consciously and find yourself looking at thinking, oh, that's interesting. Let's have a quick go with that. It's not great, really. It's kind of a gambler's kind of attitude. What you might want to do is think about, okay, well, let's have a look. I'm interested in currencies. Why don't I find more about it? And then I can bring it into my trading plan when I'm comfortable with that. I think that's absolutely the right thing to do. So just being limited to one market isn't the right thing, but you should be making those decisions consciously. And so a trading plan is not set in stone. It's something that can adapt over time, but it's something that you should adapt on as you review it, not just because you fancy trading a different market because it's got a nice clever name or something. How much will you risk on a trade? Very important. Again, I've seen so many people who come to me and say, well, I'm doing really well with my trading and this, that, and the other. Actually, I remember a while ago, this is probably about 10, 15 years ago, somebody said to me, I'm looking to get into investment management, and I've got this track record. And so he sent it over, and I said, well, what about these 2 or 3 trades here? This one here, you wiped out about 80% of your account. What's happened here? You can't manage money like that. And he said, well, no, but that was a different type of trade. I heard about something, so I thought I'd just sort of go for it. But no, but I wouldn't do that if I was managing somebody else's money. I was like, well, really? Are you sure? You sure you wouldn't? Who knows? I don't know. Certainly, I'm not going to take a risk with someone like that. It's just like the concept that suddenly you can do so well and so well and so well, and then suddenly you blasted 80% of his account on one trade because you thought, yeah, just let's just go for it. Why not? It's like, what you doing? That's not an appropriate way in which you manage risk. And of course, like I said, you need to look after the capital in your account. You need to look to trade it in the right way because you'll have worked extremely hard in order to get it. So you should be treating it with the respect that it deserves, right? And as I said, you'd be amazed with those that don't. But look, how much risk you on a trade. If that's 1%, 2%, then stick to that. Don't suddenly just start risking 30% on a trade. Make sure that you understand how risk works and how your broker trade sizes before you place a trade, because there's certain things you can look at. If suddenly you trade with a new broker and their points or pip measurement is slightly different, then suddenly you can trade 10 times bigger or a tenth of the size that you should. Just make sure that you're managing that effectively. How will you look to increase your risk? Will you compound your account as your account grows? Will you start to increase your trade size and so on? These are important things to consider. What will be your rules of entering a trade? Should there be a rules-based approach? That's up to you with your own trading strategies. Now, at Trendsignal, we can provide strategies and teach strategies using technology that we've built here. But whether you're using Trendsignal strategies or not, you should absolutely have it written down. What am I going to need? What do I need for me to see on a trade or an opportunity or a chart or the fundamentals or whatever in order for me to make a trading decision? That needs to be specific. Okay, so that you're not suddenly making a bit of a punt. Your exit strategy, what are the rules I need to engage with if I'm going to exit a trade? Just so you're not making emotional decisions. Very easy to make emotional decisions with an exit of a trade in particular. But if you've got a rules-based approach, so I must have a stop loss in, and my stop loss must be based on X, Y, and Z, even if there's a few different variables, that's okay as long as you're, again, thinking about it. How will you manage those trades? Well, is there a way in which I might exit my trade before it hits my stop loss or my target? What about economic data? What about bank holidays? What about the weekend? What about if I'm going to go on holiday? Maybe just think about these. I'm not saying you need some dossier going through every single permutation, but you need to think about it. How are you going to manage a trade? So again, you're not making decisions based on the emotions of it. Oh God, I'm going to close this trade just because I feel a bit panicky. That's not a reason, because apart from anything else, the market doesn't care whether you're panicky or not. So the market isn't going to change direction just because John Smith needs some new underpants. That's not what it's all about. It should be about, well, I'm doing it because, look, I had 5 trades last night. 4 of them have already hit target, and that's great. One of them's really flagging behind, but they're correlated, right? So if that one's flagging behind, it means it's probably not going to do it. So do you know what I'm going to do? I'm going to close that off now because it's probably going to go back the other way. So you can make conscious decisions, or because of a technical reason, I'm going to close it out now because actually my indicator's starting to turn the other way yet. So I'd rather exit it now before the market goes all the way back down to my stop loss. I'm looking to manage my risk, because in managing my risk and exiting some of those trades, it means I can lead to a much more smoother outcome and a smoother equity curve. What other factors should we consider? Economic data, perhaps, and so on. How will you review your trades? Will you look at your trades on a quarterly basis, a monthly basis, in order to work out whether your strategy is right? Are you following your strategy? And does your trading plan need a little bit of a tweak? And if you treat your trading plan in this way, it will lead to a much more successful outcome, actually, because it's much more considered, much more focused, and so on. All right. It sounds like a lot of work. It actually isn't. It actually falls into place relatively quickly, particularly if you've got a strategy like ours at Trendsignal, because a lot of this stuff has really been taken care of. So in terms of time frames, here, when do you want to look at the markets? Are you going to be a day trader, a position trader, a swing trader, an investor? That's determined by how often you can look at the markets. Can you look at the markets once a day? Can you look several times a day? Can you look at the markets for a few hours a day? When might that actually be? Will determine on what type of market or time frame you want to trade. So for example, someone like myself, I run a business, I've got 3 kids, I predominantly trade end of day trading. So I'm putting my new positions on in the evening after my kids go to bed, and that's fine. I'm absolutely okay with that. Now, because I'm trading end of day or daily chart trades, I'm holding positions for several days, right? Which means I'm looking for reasonably big sized moves, which means I can absorb a reasonable amount of cost or spread into those moves. So if I'm looking for a 100-point move, I don't mind paying quite a big spread. If I'm looking for a 10-point move, I can't afford to have that much of a spread or dealing cost, right? Because I'm going to be trading more actively, looking for much more small moves and so on. What this means is the higher the time frame we trade, so the further out the time frame that we're trading and the bigger the trade duration, the more cost we can absorb into that profit target or objective, which means the more flexibility we have over the markets we trade, because some markets are more expensive to trade than others, or some markets move more or move less than others. So that means for a daily chart trading, you can trade FX, you can trade indices, you can trade commodities, you can trade stocks. You've got quite a lot of flexibility there, both in terms of its movement and the dealing costs as well. Time required, 20-30 minutes a day, usually. It really depends. This is ballpark, right? This really depends on the strategy that you're looking to trade, and how that strategy works out. You could trade the 4-hour charts if you want to look at the markets every few hours. That's quite good for someone who's self-employed or retired. It's kind of like holding hands with the market, but not jumping into bed with it. 4-hour chart trading, it's going to be a bit more active. So you're holding positions for maybe 1 or 2 or 3 days, in which case it's shorter durations, which means smaller targets, which means we need a little bit more careful about those dealing costs and about the range of movement that we're looking at. So you might want to be a little bit more careful about some of the markets you might want to trade, but you're trading more actively, which means that there's more opportunities for profit. So if you're trading, say, 10 times a month, but now suddenly you're trading 30 times a month, there's more potential for profit with that, which means the potential returns can be higher. Obviously, the more trading opportunities you place, the more potential times there are that you can have a winning trade. Okay. And then equally, if you go down to something like a 2 to 5 minute chart, these are good time frames for people who've got 2 hours, an hour, 2, 3 hours a day, or every 3 or 4 times a week, maybe, that they can allocate to trading. I find that that's a good time period, because what it means is if you trade for an hour, there's 32-minute candlesticks in an hour. There's plenty of opportunity for a trade or two within that 1 hour time period, which means you're getting a good potential return from the time you employ. And that's important. You've got to look at how much time you're putting into something and what you can then look to get out of it. What I find about trading a 15-minute chart is that you have a trade every 15 minutes. It's really boring. It's hard to do stuff otherwise, so you kind of sat there staring at the chart. It's boring. You end up missing lots of trades. It ends up becoming a really difficult user experience, we put it that way. Same with a 60-minute chart. It actually is quite hard to slot a 60-minute chart or a 15-minute chart into your day. I find that's not to say there aren't people out there making lots of money with it. There probably are. But for me, I find that if you want to be effective on a 15-minute chart, you probably need to be sat there at your desk for 6 or 7 or 8 hours. I have no interest in doing that, and nor do most people. You might think you do. It might sound kind of fun, interesting, but it's not. Trading's quite an isolated thing, really. You're kind of on your own, and you sort of sat there chained to your desk and nothing else really going on. It's a little bit solitary, and in which case, being there all day, you might think, okay, it's fine, and probably after about 2 weeks, you think, you know what, it just isn't for me. Whereas trading on something like a 2-minute chart or a 5-minute chart sounds a bit fast, but it isn't really. What it is something where you can then allocate, say, let's say, for example, 2 hours to the charts in a day to trading. Do it for 2 hours in the morning and then go off and do something else for the rest of the day. You can actually get a lot of trading done in that amount of time. So it actually tends to slot in with most people's lifestyle, whether you're retired, self-employed, or whether you work full time but you want to do a bit of day trading in the evening, trading, say, the US stock market. You can do that too. Okay. Okay, Lily, there's good questions here. So, is this information included in the education package? Yeah, basically, a lot of this stuff is taken care of, or the trading plan taken care of with the program. Absolutely. Time is required for education before starting real training. I would say so. Some people like to get into their trading quite quickly, but you do need to understand some of the basics. So, but I wouldn't say it doesn't have to take too long. It depends on you. I mean, some people, if they started with our training, they could be up and live trading within a couple of days. Because they're, taking the bull by the horns, as it were. Even if they're brand new to it, they're just, that type of person where they just want to not really get on with it, but they're more active in their approach with it. Other people might take them a month before they start to live trade, but then maybe that's because they're really busy and they just, picking it up, putting it down again. It kind of depends on the individual and how much time you have. But realistically, if it's something that you're interested in doing and you're prepared to do 3 or 4 hours work over a couple of days, looking at some videos, one-to-one coaching sessions, training sessions, so on, then actually you could be up and running and confident enough to be placing real trades within sort of a couple of days. In terms of daily chart trading, Lily, is this for a full-time employed person? It's for anybody, actually. So what you'll find people who are trading off the daily chart it is the time frame that best suits the most people. So whether you work full-time, it's quite easy for most people to allocate 20 minutes a day to it in terms of the day-to-day application. So looking for a trade, placing the trade, and so on. 4-hour charts requires a bit more time, which means there's less people that are able to commit, able to commit that time. Day trading requires, again, even more time, so therefore there are even less people that are able and desire to commit that amount of time. So it depends on what you want to do and where you are, whether you're retired, self-employed, computer-based, whether you do shift work, and so on. What I often find is, though, Lily, and thanks for the series of questions there, is that The daily chart is an excellent starting point, even if you have more time, because it's more, uh, you've got a little bit more time to make those decisions. You've got a bit more time to learn it and so on, because it's less sensitive to um, the rapid execution that you need on, say, a 2-minute chart. So what I find is the daily chart is a really good starting point. Often what happens is people then prove to themselves that actually they do like it, they are quite good at it, they are getting the right results, and then they look to progress to a shorter time frame like a 2-minute chart or a 5-minute chart, because it's by that point they're saying, do you know what, I'm confident with this, I do now want to invest more of my time into this activity. Okay, which I tend to find is the much better way around. By if you start on trading on a 15-minute chart or a 2-minute chart, the emotional side is a little bit stronger. You've also got to allocate more time to it, and you'll probably, because of that, make decisions based on your success over a week or 3 weeks, and think, you know what, I'm not sure this is for me. Well, the reason it's not for you is because you've gone probably a bit too far too quickly. I would say it's far better to start on something like a daily chart and be more passive, more relaxed with it. And then after, let's say, a month, 6 months, a couple of years, depending on you and your situation, you could then look to progress to shorter term trading from there. By which time, what you've done there is you've built up the confidence in what you're doing. You're aware of how the markets actually function, and you're able to make a much better um, uh, result with any day trading you might then progress to. Okay, so hopefully that's helpful. What I do see is people who jump straight into day trading, and it's fine for some people. Don't get me wrong. Some people have emotionally they're okay with it. And it works. But for a lot of people, it may not be quite right. So a more relaxed approach. And as I said, doesn't say it means that it takes like 3 years to get onto day trading. But I often find it's easier to make money with end of day trading for a newbie than it is for a newbie to make money from intraday trading. And that's, I guess, probably really what it comes down to, is what is my likelihood of being successful with this? And what have I got to do in order to increase my likelihood of being successful with this? That's kind of what I'm going through right now. Okay, so hopefully that helps, Lily. I went a little bit off topic there, I think, probably. Kadom, realistically, how much time is required to understand the system and to be able to trade it effectively? Not a lot. Well, with our system, so the D1 sniper strategy is rules based. So, really you're looking at a few hours. I'd say you have a 2-hour training session, maybe a couple of workshops, a couple of one-to-one coaching sessions. You're looking at a few hours that might take a week, 3 or 4 days maybe. Some people actually consume that information really quickly. It just depends on the type of person you are. Some people obviously might need to explain things a couple of times. And again, it's a little bit like, you look at your class at school. Why do some people pick things up really quicker than others? How long does it take to learn the French language? Or for grade one, I'm afraid that it depends on the individual, right? But really, you could get this done in probably a few days, and then you could be trading the D1 sniper strategy on the Trend Signal Plus system, within a couple of days, and you could be trading it pretty well in that regard. You will then use that as a platform to then develop your skills and start to understand a little bit more about how to get better returns, how to smooth your returns, how to look for bigger targets in certain situations, and so on. Okay. But when you think about what we do, is we take a subject which is very complicated, right? And then we provide a solution to traders to break that complexity down. It's a little bit like you can go and build your own car if you want to, but or you can go and buy a car which is already proved to work, and then they'll teach you how to drive it and to use it effectively and so on. That's the same sort of principle here. Okay, discipline determines your level of success, exactly. So we're kind of going through some of these bits, a bit as I said earlier. Trade sizing, you want to make sure you're managing your risk effectively. I'm going to go through this relatively quickly, so I've massively overrun, as I always do. Increasing your trade size, think about this. Increasing your trade size will apply different pressure to you. So this shouldn't be a race to make big money. You could say it's a race in order to get success and to be confident and to build that discipline. But really, that should start off on a small basis first. Prove to yourself that you can do this first. Once you've proved to yourself there, then that means you start to trade based on what the charts are saying rather than the emotional side of it. Because if you're focused and geared by the emotions, it means you're more likely to lose. Okay, so the more you can focus on what the charts are telling you and remove the emotion side away, the better your trading is likely to be. And what happens is that financial pressures tend to extend emotional pressures. So if you're trading because you want to make money loads of really quickly, the fear and the greed is going to take over, which means you'll start to break the rules of your strategy. You'll start to do all sorts of weird and wonderful trading decisions rather than focusing on what the charts are actually telling you. If you can try and keep the money side away and focus on the charts and a more pragmatic approach, you'll generally get much better trades. Okay. Okay, got a couple of bits here. Lily, no problem. Thank you. Do we need to register with a trader? Kadam, just get in touch with us. You can go to trend-signal.com and we can help take you through the program. John, I have to say it's really quick to learn. Brilliant company with patient expert coaches, a company that I want to work with more and more in the future. That's great, John. Lovely. I really appreciate that. Thank you. And I didn't just make that up. Someone's just typed that in. John's just typed it in. That's lovely. Okay. What else? Think about your economic calendar. I do another session on these. Typically, these screen shares I do are on a Tuesday. But if you look back on Facebook, you look back on YouTube, you'll see how to trade news and events. And there's a session that I've done there, I don't know, a month or three ago maybe. And you can go back and have a look at that recording. And it talks about economic data. It talks about the most important ones. It talks about the impact that it has on prices. So I'd encourage you to have a look at that now because, like I said, I'm overrunning, but the content's there. It's out there. It's available. So just look up Trend Signal on YouTube or Facebook, and you'll see some of these streams there. Okay, and then review. Review what you're doing. It's a really interesting what's the word podcast I was listening to a couple of years ago. Cautionary Tales. I encourage you to look it up. It was excellent. Anyway, one of the cautionary tales was about sticking to a particular pathway and not deviating from it. So being set to it, even though that pathway, everybody knew it wasn't going to work and it wasn't right. It was to do with I think it was an oil tanker, and effectively they stuck to an original pathway, even though they knew they're probably going to end up crashing. But the driver, is that the right word, just wasn't open to, this is my plan, this is what I will stick to, it is rigid, blah, blah, blah. Even though it's very, very flawed. What we have to be is a little bit more nimble than this. But again, we have to look to do it consciously. We should review the plan that we have in place. Is it still right? Is it still appropriate? Are there ways in which we might want to tweak it? For example, maybe only small tweaks, but it should be an exercise that we do. And actually review the trades that you place. Did I meet the rules? Was that bit of a punt? What could I have done to come up with a better outcome? I play a lot of golf. Well, I used to before I had kids, really. But playing golf, what I would always do is I would consider my round afterwards, and I would look at what have I done right. Great. What have I done wrong? What have I done badly? What can I do about it to improve it for next time? And you have to do that. You have to do that in anything in life, really, without getting on my soapbox here and lecturing anybody. But we should be looking at these things and thinking, okay, well, as long as it's not an emotional decision we make, and as long as we're looking at it in the right way, what have I done wrong here? Was there an element of my game that's not quite right? And what can I take from that to help me into the future? If you do that, look at what you're doing and allowing yourself to be better the next time, then you'll end up with a much better outcome. Zorro, have a look on here. If you see the contact details there, get in touch with us and we can go through those questions with you. Oh, thanks, Sean. Yeah, it says John for some reason, but thank you, Sean. That's great. Okay, so that's it, guys. I'm going to call an end. If anyone does want to get in touch, or if you want us to contact you, actually, if you're interested in our systems and you want to find out a bit more about how our trading systems work, our education works, then just pop your phone number into the questions box, and I'll ask one of the team to get in touch with you and see and take from there. We can go through how everything you want to know. Alternatively, there's our contact details there. So if you want to find out a little bit more about trend signal and how we can help you to trade more effectively, just contact us. Otherwise, everybody, I'm going to call it an end to today's session. It is, after all, the 21st of December. So I'm going to wish everybody a wonderful Christmas and festive period. I hope you have a great time with you and yours. And we'll be back. I'm not doing a screen share next week. So the next screen share that I'll do, I think, will be, I think it's the second week of January, actually. So it'll be the 9th or 10th of January, where we go through some more of this educational stuff. But otherwise, have a wonderful week, guys. Have a wonderful Christmas period and New Year. And I wish you all the best. Bye bye for now.